Well, let's go to Chris Weston at IG Markets for you in Melbourne. Chris, we always knew that the focus coming into today's session was going to be a reaction to that stimulus push by Europe overnight. Did they kind of, as some have said, look, just fall short because unconventional measures were available and they didn't avail themselves?
Yeah, I think it's pretty hard to print. I think what we also need to remember is that the Nigerian central bank came out and cut rates as well, and so did the Danish central bank. That didn't get too much airplay, but yeah, maybe there was an element of people looking for another long-term refinancing operation. Perhaps there was an element of people saying that we want to see a resumption of the securities market program. Did anyone really expect to see them? I don't think they did. I mean, I've looked at a lot of investment banks research, and none of them were saying that we're likely to see that. But yeah, the fall that we saw in the euro, I mean, it collapsed 125.60 and 123.64. So yeah, pretty good move. I mean, we've seen the euro record levels against the Aussie. That's been widely reported. Record lows against the Kiwi dollar, lowest levels in years against the Canadian and you know, the Swedish krona as well. So the euro is now clearly being used as a funding currency because of I think it's probably more down to what some of the comments we saw from Mario Draghi. You know, he said that inflation risks right now are broadly balanced, but said that it would be down below 2% going forward. And then I think that the real situation where he came out and said, look, you know, we're happy to act as an agent on behalf of the European Stability Mechanism, the EFSF. If they do come out and buy bonds in the secondary market, fine. We've got the experience because we've had the securities market program. We'll act as an agent, fine, but we are not going to act as a bank. We are not going to fund the ESM or the EFSF in any way. And we're not going to put risks on our balance sheet. And as soon as those comments came out in the press conference, Spanish-Italian borrowing costs came right up. I mean, on the day, I think the 2-year Spanish bond was up about 52 basis points. So I think that moment really took some of the further wind out of the sails. Prior to that, we had a Spanish bond auction, which, you know, fine, they've done well getting the money away in this market, and I think they're taking advantage of the lower yields which we got from the summit. But the bid to cover was certainly lower than the previous one, around about 2.1. The previous one was about 3.3. So that took a bit of wind out of the sails. I personally think, you know, if the price action as well, you've got the deposit rate which is being cut down to 0. Is that really going to help things? I don't know. I mean, I just don't think the banks want to lend to each other at the moment. There's still an element of distrust. Fine, it's not really being reiterated hugely in the credit markets at the moment, but the banks want to park money with the ECB. They've had a lot of that taken away because of the deposit rate. So yeah, I think there was, you know, you're looking at the euro side of things, and clearly the message from Draghi, plus the fact that they're cutting rates, has just really been seen that the euro really being stamped as being used as the funding currency of choice now, hence why we saw the big weakness coming through.
It's really interesting because the debate, which has still not been squared, is who is going to be the banking supervisor for the region. It's clear that people are wanting the ECB itself to assume that mandate, which then, of course, begs the question, does that undermine their independence? So, you know, how is that going to really kind of, in the final washout, be determined? If Draghi won't sign up to it, if it's crucial to move things towards closer economic union for Europe, we're in an impasse.
Yeah, I don't know how this is all going to go, Carson. This is one of those things. I think, you know, if you look at the press, I think first of all, everyone was having a right old go at Merkel, saying that she'd sold her soul, she's given up too much at the EU summit. The day after, you know, on the Saturday, we actually saw quite a lot of newspapers in Germany coming out and saying, actually, she's pulled off a masterstroke by what she's done, that she's allowed, because she's given in some more constraints, it's allowed more sort of, I suppose, ability to be more aggressive in terms of fiscal discipline going forward. So that's the situation. I think we need to see some sort of fiscal discipline being administered by the different European countries before we can have some sort of banking supervisory board. I think ultimately it will have to lie down on the ECB or some sort of derivative of that. Yeah. And I think it's quite interesting as well that people within the ECB are complaining bitterly at the moment about the long hours they're having to work. They've been complaining to Mario Draghi just because of the huge workload they've got. So, you know, I think there'll be people within the ECB who won't want to see that happening. But it has to first of all fall on on the fiscal discipline first. That's clear that the Germans are going through that. The ECB are quite clear to that. And I think what's also interesting to do is Mario Draghi's comments, and it's clear that he's stated just because government actions have come through, it doesn't mean that we're going to come out and reward you for doing that as well. So as it stands at the moment, I think that the banking supervision is something that the market clearly wants to see in terms of discipline, in terms of guarantees, etc., etc. But we have to see the baby steps coming first, and that has to start with fiscal discipline. And I think Germany have been pushing for that one.
Still, yeah, I'm still struggling to see how you can have fiscal discipline if you don't have a supervisor to make sure that lending is going in the right direction and to the right parts of the economy, and not to overheated ones to just exacerbate existing problems. That is a bigger picture debate, of course. Really bizarre, before we move on, incidentally, Draghi making the remark, downside risks to growth outlook have materialised. And Dow Jones Newswire rightly points out we didn't know that Europe actually had a growth outlook, but no matter.
No.
You know. Anyway, let's move on.
No, well, I mean, German PMIs now are firmly in contractionary territory. The PMIs across the border are woeful. The employment components, the employment in all countries is falling away, mostly in the periphery. I mean, that's right. I mean, I think UBS came out the other day and said that we're likely to see about 1.7% contraction in European GDP next year. So, yeah, that certainly doesn't bode too well. I mean, I think that's the ultimate guide here, and we need to take a step back from the summit. Ultimately, we need to find out where the growth is coming from. Where's the debt? How's the debt going to be repaid? That hasn't really been addressed at the moment. And where's the growth coming from? Until those areas can be, really, we can find some sort of projection for that. We are going to see these bouts of volatility because the markets just want to see where the growth's coming from.
Well, let's look at a regional market not open for trade yet. The composite, the reaction to moves overnight on stimulus from that market. Surprise rate cut.
Yep.
Really, though, we've got some key economic data due next week. So will any big bets be placed on that decision ahead of the data drop?
Well, I think the interest rate was expected, to be honest. I just think the timing's very much out of kilter. The Securities Journal in China had been reporting that we were likely to see a reserve ratio cut, not an interest rate cut. If you actually look at the benchmark lending rates, they have been increasing in China, so it's probably not a huge surprise that we've seen them come and neutralise that a little bit. Of course, people immediately came out and said 2 rate cuts in a month. It's got to show that the PBOC are slightly concerned with growth. I think realistically what we see now is the PBOC shifting firmly away from inflation fears, and it's all about supporting growth coming forward. Have they done that again just before this data drop, as you talk about? That's going to have the bears, it's going to feed the bears ammunition. But what is interesting now from a technical basis is the uptrend that's been in place from 2008 on a weekly basis comes in at 2204. We're trading below that at the moment. There's a very good chance we could see the Shanghai Composite coming off quite sharply today. Effectively cutting the lending rate does feed into profitability for Chinese banks. I think Deutsche said that they were
and that's a very good point. It feeds into profitability. In other words, it actually crimps their profitability. Yes, it weakens it. So
exactly. Well, Deutsche have said that for this full year they're cutting Chinese banks by about 6% in terms of earnings, so that's not a good situation. I think there was another investment bank, I can't remember who, said that depending on how rigorous we see in terms of interest rate cuts going forward, and they're saying that the interest rate cut today shows that the PBOC could be getting on this snowballing aggressive bias. We could see EPS being cut anywhere between, and wait for it, 10 to 54%. It's quite a spread, but I mean that doesn't sort of. It's going to act as a big headwind for banks, there's no doubt about that.
Yeah, and therefore begs the question, the pass-through on lending. We were just discussing that with the European banks. Where will their willingness lie to lend if their profitability in the process is, if anything, squeezed?
Well, I think they'll probably be leaned on pretty heavily by the PBOC. I think they've got that sort of idea. The PBOC have a little bit more of a, I suppose, influence on the banks than perhaps Glenn Stevens would, or the policy setters over in Australia would have on NAB and CBA, for example. So I think if things do get a bit of countered, I think the PBOC will, especially in the handover year as well, will make sure that money's being put out. I think you've got to keep an eye on new yuan loans next week as well. The market's looking for about 900 billion, which is slightly up from last month. That's a metric which is getting a lot more of a look in nowadays. I also think you've got to look at CPI. Now, CPI is expected to be at 2% 3.3%. How on earth they've managed to get CPI from 6.6% last July down to 2.3%, it staggers me. It's just amazing how they've done that.
Well, it's kind of a, we'll kind of debate that one ad nauseum, but let's just actually then ponder the real event for this week, which comes tonight our time. The curtain raiser for it, the ADP private sector survey on jobs. Is this now effectively watering down Fed intervention? Fewer bets in place ahead of tonight's report because of ADP, or no correlation whatsoever?
Well, the correlation with ADP, I mean, it's a good predictor of the direction. I get more ADP job numbers. Generally, you get an improvement in the actual non-farm payrolls. It's actually a terrible predictor in terms of actual quantitative numbers. But and that's what we saw last night. I mean, Goldman's have revised theirs up. They got a lot of press last night. Morgan Stanley have also revised that. The headline number has now increased from expectations yesterday of 90,000 to now 100,000. You've got to look at the other leading indicators. The employment components of the service sector data last night showed improvement. That's good. Manufacturing employment component of the ISM recently, I think earlier in the week, showed some sort of improvement. You've got Challenger reporting fewer layoffs have been reported. The initial claims have been falling as well. The 4-week moving average has been coming down. Online advertisements have been ramping up. All the anecdotal evidence suggests we are going to get an improvement in the number. To me, that's probably a contrarian indicator. We've seen it time and time again where these numbers come through and we actually get a worse than expected number. And personally, for me, I don't want to get an inline number. I want to see either the jobs number absolutely smash it to the upside, or we actually get a really terrible number. It gives us some sort of clarity, 20,000 or below job losses. It gives us clarity, and we'll probably see after an initial sell-off, we'll see risk assets probably have a big rally because the chances the Fed are going to come out and join the intervention teams of the Bank of England and the ECB. So I think a terrible number, we get some sort of clarity on what the Fed are doing. We get a really good number, and we get the dollar strengthens and equity markets probably rally on the growth perspective. But an inline number at 100,000, it's just muddling along. It's not really giving us anything. So to get clarity.
Okay, that's interesting. So even if we get a better than expected, you say we still get a market rally on growth, being still in the mix, regardless.
Well, let's look at the anecdotal evidence, Carson. I mean, last night we got an ADP job number that came out, and what did we see? We saw risk assets stabilise overnight. The euro pushed up a little bit on the risk appetite. We saw commodities stabilise, so perhaps that's going to feed into it. Well, I think it depends on the size of the number. If we, the consensus is 100,000. If we get 120, it's not going to mean anything. I'm talking about a really strong number, 170,000 up to 200,000 plus. It would just be. I mean, the expectations, the consensus or the range is between 165,000 jobs and 35,000 jobs. So, we've been surprised many times before on this. It's a lottery. How they pick this number, it's just, it could be anything.
The bigger picture problem, and you go back to the street and talk to any big corporate you care to mention, they are not hiring because they don't have any clarity on tax certainty moving forward, and that much. Why would you go and swell your ranks ahead of big decisions that haven't been taken, important ones that have been put into the and they've been left at the bottom of the inbox and the in tray for far too long? Chris,
and you've probably got big corporations as well who've been paying bankrolling Mitt Romney as well, really hoping that comes on, and then obviously if Obama gets in, you're going to get it sort of slapped back at you as well. So I mean, it's going to be very interesting. But I think you've got that too dichotomy, and I think what we're seeing today in Australia is people just very much sitting on their hands, waiting for some clarity. I mean, I think all in all, last night with the 5 central banks, including Nigeria, if you've got that concerted effort,
I cannot believe you have gone for Nigeria. Since when have you talked about Nigeria in a cross? That is bizarre.
No, I mean, it hasn't really got all respect to Nigeria, hasn't really got a bearing on risk assets. But I think any other day, given what we saw with the Bank of England, 50 billion, and everything else from the PBOC, I think you probably would have had a risk-on rally. So I think it's about hoping the Fed come through. I mean, I still personally sit in the camp that I'd rather see huge job growth than markets going on a sugar high from any kind of QE intervention. I think that's what we'd like to see. organic growth as opposed to artificial growth. But unfortunately, I think the whisper numbers now that are 110,000. They're slightly just positioned above that. Yeah, I think there's obviously. I think personally there's downside risk to that non-farm payroll. So yeah, I think if we do get a weak number, then you're probably going to get follow-through selling. Gold will be, doing quite nicely. You'll probably get a close above that recent, that double top that we've seen, 1625. Oil will do pretty well. Backed up by the antagonistic foreign policy that Iran have got. So we have to see, but it's not about prophesising; it's about reacting. I think in this.
The upside risk is that if I go any longer with you, we need to do the whole show with you. So we will have to thank you now. All right.
Sorry about that.
And we'll talk. No. Thank you very much. Appreciate your insights, Chris. Have a good weekend.
Cheers.
Chris Weston from IG Markets.